All right, for this video, I wanted to go over 6 different types of entity structure options for US-based businesses that are going to have a mix of US and non-US owners. Okay, so very common structure nowadays overall, right? We live in a global marketplace. We have entrepreneurs that live in different countries that meet and decide to go into business with each other, and everybody's working remotely. You have offices all over the place. So when you have these types of arrangements where you have US and non-US persons that are joining together to form a company, there's tax issues obviously for the US person because they live and work in the US, they're a US citizen, and then the non-US person, right, because they're invested in a US company. So what are the different types of structures we could put together that benefit not just the company, but try to benefit everybody that's an owner as well? So I've got 6 options here. We'll go through the structure itself, some of the highlights of it, like what it means that you have to be filing every year, and then a list of pros and cons for each one, and then I'll kind of pull it all together at the end and give you a recommendation as to what I think is kind of the best one to work with. So, okay, so let's dive into the first one here, right? So this is going to be the most straightforward structure that you have. Now, most of the time when I get new calls from clients, they were thinking about doing it this way, or they've already done it this way, and now they need to figure out, well, was that right? What are the tax issues? Do I need to change something? So this is an LLC partnership structure where direct ownership of the owners, right? So what I mean is the individuals that are the owners here own the LLC units directly, as opposed to indirectly where they have an intermediary entity in there, right? So we have a Delaware LLC. Now, LLCs in the US, when they have more than one owner, they are automatically treated as a partnership for federal tax purposes. So we've got Frank here, he's a US citizen and tax resident, he's going to own 60%. And his business partner, Emma, she is a Cayman Islands citizen and tax resident, and she's going to own the other 40. And you can see here that they own their LLC units directly. Okay, so that's the direct ownership. Now, the Delaware LLC here, this is going to be the active business entity, and this is meaning the customer-facing entity. So this is the entity that's going to bring in the revenue, it's going to have expenses, it's going to enter into contracts, and the reason why I want to make that distinction very clear is because as we add other entities to this structure, you're going to have intermediary entities that don't really do anything other than just hold membership units in the operating company. Okay, so very important we distinguish between what is going to be that active business entity that's generating the income, and then what other types of entities are we inserting in the structure here that are just holding companies or other types of flow-through entities. Now, for all of these structures, including this one, we should assume that the entity is engaged in trade or business, it has US source ECI, so it's going to be owing tax on that net income. All right, now I won't go into US trade or business too much in this video because it's beyond the scope. I have other videos that cover US TOB and ECI issues, so I'll put links to those below. But if you want to learn more about what that means exactly, short answer is it means the entity is subject to US tax because it's engaged in US trade or business. You can have US entities that are flow through that don't have any US trade or business or ECI, so they're US persons for a lot of these tax rules, but they're not actually owning any tax, and neither are the non-residents. Okay, so what about the filings? Well, when you have this type of arrangement, the US LLC has to file a 1065 partnership return, and every single owner gets a K1. So a K1 is issued to each owner, and it shows their allocation of the income, expense, other types of items flowing through to it, their capital contributions, their distributions, what are their ending capital accounts. All that information gets reported on a K1. Now, very important here to note that the US LLC cannot make an S election. Okay, so the S election is only made if you have an eligible corporation, which means the entity is a US entity, it has less than 100 or less shareholders, and it can only have US natural persons as owners, and they have to be US residents. In this case, because Emma is a direct owner, you cannot make the S election because she's an ineligible shareholder. Very, very important, right? Because I've had conversations where the US person says, oh, everybody told me about making an S election because it helps me with my self-employment taxes, so can we do that? In this type of structure, no, you can't, because you have a non-resident LLC owner in the mix, which invalidates the ability to make an S corporation election. Okay. Now, what are the U.S. tax issues? So the Delaware LLC files that partnership return. Frank gets his allocation of income. He reports it on his 1040. He pays taxes. Nothing too complicated there. Emma, because Emma is a non-resident and she's invested in a company that is engaged in U.S. trade or business, she's subject to income tax withholding on her allocation of the net ECI, right? So the current rates as of 2022 are 37% withholding on any allocation of income from the Delaware LLC to Emma, right? So the partnership would do its 1065. It would also need to file Form 8804 and 8805, withhold tax on the allocation of income to Emma. And then Emma should be filing a 1040-NR to report the income and pay the tax and then claim credit for the withholding, right? She very often might get a refund depending on what the overall income amount is that's being allocated to her. Okay, so what are some of the pros and cons of doing it this way? So the pros, simple structure, only one entity, right? The more entities you add, the more of a compliance nightmare you have, the more filing fees and costs, things like that. So the nice thing is, it is a very lean structure. You do have just one company. Now, the other pro here, again, is the pass-through tax treatment for the U.S. resident. This is generally better for U.S. tax residents because if we think about what would it mean for that U.S. person to hold interest in a C corporation, C corporations pay tax at 21%, and then any dividend distributions paid out to the U.S. resident owner are going to be subject to either the qualified dividend, reduced tax rate, or ordinary income, depending on their holding period for the company. So the overall effective tax rate for a lot of U.S. residents is higher if they're operating a C corporation versus a pass-through entity. Now, what are some of the cons here? When U.S. residents are invested in a partnership and they actively participate in the business, their allocation of the income is certainly subject to federal income taxes, but it's also subject to self-employment taxes, right? So the 15.3% on their allocation is that additional tax that they've got to be paying. And so this is exactly why many LLCs elect an S corporation status, because they're trying to minimize that self-employment exposure. Now, the other con here, the non-U.S. partners are subject to that withholding tax of 37%. 37% is a lot of money. And again, that is applied regardless of whether any cash is actually distributed to the non-resident owner. Remember, it's an allocation on the net income. So even if there are no distributions made to the owners during the year, the 37% still applies, right? And it's a 21% withholding tax if the owner is a foreign corporation. In this example, Emma is obviously not a foreign corporation. She's a natural person, an individual. So her withholding rate is the 37%. Okay. Now, the non-U.S. partners, the other con here is they should be getting an I-10, which is necessary to file the 1040-NR, right? So after Emma has the taxes withheld on her allocation of income, in order for her to reclaim some of the money as a refund, if she's eligible, she needs to file a 1040-NR. You can't file a 1040-NR without getting an I-10. So the I-10 application process is relatively straightforward, but as I note here in the second sentence, a lot of non-residents don't want to obtain an I-10 because they just don't want to be on the map, so to speak, in the U.S. on a personal level, and they don't want to go through the exercise of filing tax returns, right? And that's fair. And so that's one reason why we structure things a little differently, and we'll see those in the examples later on in the slide deck. Now, the other issue here, the last point, and this is going to come up a lot throughout the rest of the examples, but when you have non-U.S. persons that are holding U.S. situs assets, they are potentially subject to the U.S. estate tax, okay? Now, the estate tax, most of us are fairly familiar with that, right? The idea is if your net worth is over, let's say, it changes every year, if 12 million roughly and change it is currently, if you're worth more than 12 million and you die, the federal government will impose an estate tax on anything over that $12 million, right? So it is a tax that doesn't apply to everybody, certainly, but it can apply in certain cases for U.S. persons. With non-residents, so if you are a non-U.S. person and you hold U.S. situs assets, which include U.S. companies, the estate tax exclusion is only $60,000, okay? So if Emma is invested in that U.S. business, and let's say her allocation, her shares in that LLC are worth $500,000 and she dies, there is an estate tax imposed on the amount over the $60,000. So Emma's, obviously she would be deceased at this point, so her personal representative of her estate would have to file an estate tax return, report $500,000 in U.S. situs assets, get a $60,000 exclusion, and then the estate would pay estate tax on that $440,000. So when people hear that, it's terrifying, right? $60,000 is very, very low. It's not $12 million, right? So when you're a non-U.S. resident and you're invested in U.S. assets, this includes U.S. stocks, U.S. bonds. It doesn't include U.S. bank accounts, but U.S. real property it includes. Anything over $60K, you're looking at paying a hefty estate tax if you pass away while holding these assets still. Okay, and so we'll talk about ways to structure it to get around that. All right, so let's look at the next option here. So this is going to be an LLC again, direct ownership, but it's going to file a C Corp election. So we have the same LLC, we have the same ownership, but instead of treating it as a partnership, the LLC files an 8832 and elects to be taxed as a C Corp. So how does that change things? Well, now the LLC, because it's not a partnership, it doesn't file a 1065, it files an 1120 corporate income tax return. It reports its income, it reports its expenses, and it pays corporate income taxes on its net taxable income. The current rate is 21%, right? And then any after-tax profits can be distributed to the owners as a dividend, right? So the U.S. resident shareholder, they file their federal return. So Frank would file his 1040. There's no income that Frank would pick up on distributions unless he actually got a dividend, right? So again, all the tax is being paid initially at the entity level. Now, the non-U.S. residents no longer have to file a 1040 NR, and here's why. Because the LLC is now a C Corp, it's a regarded entity, it's a U.S. person, a U.S. tax resident rather. So C corporations are tax residents by default, which means all the income coming into it, whether it's from the U.S. or non-U.S. sources, it's all being subjected to tax at the entity level. So the entity pays the tax. Now the non-residents, because the LLC is a C Corp and it pays tax at the entity level, they don't have to do anything further, right? So there's no flow-through income to the non-resident. There's no withholding tax that applies initially on the net taxable income. The dividends that are distributed from the LLC to the foreign person, if any, those are going to be considered U.S. source dividends, and so the U.S. source FDAP income withholding rules apply. Generally, the withholding tax on U.S. source dividends to non-residents is 30%, okay? So if the Delaware company pays out $100,000 in dividends, 60% goes to Frank, $40,000 goes to Emma. Emma is going to have a 30% withholding tax on her $40K, okay? That's how the tax is going to apply in this situation. So what are the pros and cons of this one? Well, again, we still have a simple structure, right? We've only got one entity, so minimal amount of tax filings, annual fees, etc. Now, the entity classification election doesn't change anything under Delaware law, right? So it's just a federal tax election, and that's very important. What a lot of people mistakenly believe is, well, as soon as I start making all these federal elections, now I've got to do something different with Delaware. Not the case, right? So it's still a Delaware LLC. Delaware, they call it an annual report, but basically you're just paying a $300 filing fee, making sure your registered agent is paid for and updated if necessary, and that's it. So you're not disclosing, you're not filing franchise taxes that Delaware corporations normally have to do. Okay. Now the other pro, like I noted on the last slide there when we were talking about this, was unlike the LLC partnership, the non-U.S. persons don't have to file these 1040 NRs anymore, because again, the tax is being paid at the entity level, and then if any dividend distributions are coming out, the withholding tax is also at source, and then that's it. So under the rules, as long as a non-resident has all the appropriate withholding taxes coming out at source on U.S. source FDAP income, they don't have to file a 1040 NR. Okay, so that's the nice thing. Now, let's look at this example just to illustrate how the 1042s are filed, right? So again, if dividend distributions are paid to a non-resident, withholding taxes are taken at source, sent to the IRS, and reported on 1042 and 1042S. So if LLC is 100K in profits, pays $21,000 in tax, the after-tax net profits in the corporation is $79,000, right? So that's the earnings and profits, or E&P, that's left over in the company. If the LLC distributes $20,000 in dividends, Frank gets his $12,000, so 60%, and he reports it on Schedule B of his Form 1040. So it's just dividend income to Frank. Now, when Emma gets her share, she's going to get $8,000, right? So it's 40% of the 20. Before Emma gets her dividend, the LLC, as the withholding agent in this context, has to withhold 30% in tax, which is going to be $2,400, and then Emma gets the difference, right? The withholding taxes are $2,400. They're sent to the IRS, and it's reported on a 1042 and 1042S, right? So all of this is filed by the corporation, and Emma, again, doesn't have to do anything so long as all the withholding taxes are paid at source. Now, what are the cons with this structure? From the U.S. resident perspective, no pass-through treatment, which is, again, generally that's not good, because overall you can find yourself with a lower effective tax rate if it's a pass-through entity. C corporation with a double tax issue, the net effective tax rate the U.S. resident partner will be paying on their income is generally higher. Not always the case, right? So there are no absolutes here. You really have to dive into kind of the math and see what would work. But generally speaking, pass-through tax treatment works better for these U.S. resident partners. Now, the other con here, the non-U.S. owners are paying that dividend withholding tax. 30%, again, it's high, right? You got to think the corporation is paying 21% at the entity level, and then if the non-resident is pulling out dividends and it's subject to an additional 30, they're in excess of 50% net effective taxes on their allocation of the earnings. It's a lot, right? I mean, that is definitely a lot of money. Now, the non-resident, the other thing to note here is the withholding tax is generally creditable in whatever foreign country you are. So, for example, if you live, this wouldn't apply to Emma because she's in the Cayman Islands and Caymans don't impose any taxes whatsoever. But if you lived in a foreign country that made you record the same dividend income, you can take a credit for the 30% in tax that the IRS took off the top. So you're not losing it altogether, but again, it's still a lot of money. And in Emma's context, because she doesn't pay any taxes in the Caymans, she's looking at an effective tax rate of about 50%. Okay, now, again, the same issue with this estate tax. Last bullet point here, the non-U.S. partners holding direct interest in those U.S. situs companies, potentially subject to an estate tax if they pass away while holding the asset in the U.S. in their personal name. That's generally how the estate tax works for non-residents. Anything held in your personal name that's a U.S. situs asset, when you pass away, that's part of your taxable estate. And again, you would owe estate taxes on anything over $60,000. All right, so let's move on to the next one here. This is an LLC partnership structure with a corporate intermediary. Okay, so what's the appeal with this one? So we have our same Delaware LLC up here, and it's still going to be a partnership, right? Because we have Frank, he owns 60%. But notice what we're doing here with the intermediary. Emma, instead of owning the LLC units in the LLC directly, she's going to open another Delaware corporation, and that's going to own her 40% share in the partnership. So Emma owns 100% of the Delaware Corp, and then that Delaware Corp in turn owns 40% of the Delaware LLC partnership. So how does this change things? Well, the LLC now, again, it's back to a partnership. So it files a 1065. Same limitation applies on the S election. It cannot make an S election because you have this C corporation in the mix, which is an ineligible shareholder. So S corporation off the table. Now Frank, U.S. resident, still files his 1040, and he reports his K1 allocation, 60% of that income flowing through from the partnership entity. Now, the 40% income allocation from the LLC into Emma's Delaware company, the Delaware company now is filing a Form 1120. It's reporting its share of the income, expense, it pays tax at 21%, and so the tax is being levied at this level rather than being allocated directly to Emma and being subject to that 37% withholding rate, okay? Now, the Delaware Corporation here, kind of like the last example, if it wants to pay any dividends out to Emma, it can, but the dividend withholding rules apply, right? This is a U.S. corporation. Any dividends are going to be U.S. source income, so U.S. payments out to Emma as the non-resident are going to be subject to withholding taxes, 1042, 1042S reporting, and so on. So what are the pros and cons of this one? Well, the pros is we get back to a pass-through tax treatment for the U.S. resident owner, right? So remember now, because we're back to a partnership treatment, Frank can get his 60% allocation as a pass-through rather than this entity electing to be a C corporation. Now, the Delaware LLC, because it's a partnership and its two owners are both U.S. persons, there's no withholding taxes that would apply at the Delaware LLC level, right? Because if we look at the structure chart, Frank is a U.S. person and this Delaware corporation is a U.S. person. So the allocations down to each are just to U.S. persons, so there's no 37% withholding tax, unlike the example where Emma was a direct owner in that partnership, okay? Now, the non-U.S. owner, so Emma in this case, she has complete control over whether she actually wants to take money out of that company. So her allocation of income goes into that Delaware company, pays the tax there, and then she can let the profits just sit there and accumulate if she wants, or she can decide to take a dividend distribution for the company if she so chooses, right? That's up to her. Now, what are the cons with this? Well, the U.S. resident, because we go back to that partnership treatment, the allocation of Frank is going to be subject to self-employment again. So he's got that 15.3% allocation or SC tax on the allocation of income because he actively participates in the business. Now, the other con here is the non-U.S. owner of that Delaware corporation, they're still going to have this dividend withholding tax issue, right? So the dividend withholding taxes, if they were paid out from Emma's Delaware entity to her, again, the same the same 30% withholding tax would apply unless she was a resident of a country that had a treaty and it could maybe get a reduced treaty rate. Now, the non-U.S. partners, so the estate tax issue still remains here, right? So the non-U.S. partners holding direct interest in the U.S. situs company, still subject to the estate tax. So because this is a U.S. corporation, stock in domestic corporations is a U.S. situs asset. So if Emma were to pass away, whatever the net worth is of this company, she would have to report that, well, not her obviously, but the personal representative of her estate would report the value of the stock, take the $60,000 exclusion, and then pay estate taxes on the net difference, right? Okay, so let's move on to the next one. So you can see we're just adding more and more companies here. Yeah, it's getting more fun. Okay, so this is an LLC that's going to be a partnership, and we have both S corporation and C corporation intermediary entities. Okay, so what are we changing here from the last one? Well, the right-hand side is still the same, right? We've got our partnership entity, 40% allocated down to Emma's Delaware C Corp, and then she owns 100% of that Delaware C Corp stock. So she is an indirect owner in the Delaware LLC. Now, here's where we add Frank's additional element. If Frank, instead of holding his LLC units directly, decides to open a separate LLC, make an S election, and then have that S Corp own the units in the partnership. So how does this change things? Well, we still have a Delaware LLC filing a partnership return. We have Emma's entity filing the 1120, paying taxes. Dividends coming out to Emma would be subject to that 30% withholding tax unless reduced by treaty. But on the left-hand side here, what we've done by interjecting this S Corp is we've helped Frank better manage the self-employment tax hit that he would otherwise have on this partnership income. So remember, if the partnership is allocating money directly to Frank, because it's held in his name personally, he's got to report self-employment taxes on the whole allocation. By funneling it through an S Corp here, the S Corp kind of cleans the income, and now none of it is subject to the self-employment taxes, just the ordinary income. But obviously Frank's got to comply with all of the S Corp rules, right? He's got to set himself up a salary at this entity level. He's got to set a reasonable salary, pay payroll taxes, both the employee and employer portion, and make sure he's doing everything by the book there. Now, what are the pros and cons for this one? So the pros, we still got the pass-through tax treatment for Frank, right? So from the U.S. side, we've got the pass-through treatment, not the corporate tax treatment, and so we've eliminated that double tax issue for Frank. The S Corp intermediary, again, it eliminates that self-employment hit on all of the income being allocated to Frank. So now he has better control over what portion is he going to be paying payroll taxes on. So now he can set his W-2 to a reasonable salary, and then he'll save the payroll tax hit on the net difference there. Now, the Delaware LLC, again, it's not responsible for any kind of international withholding taxes because the two owners are a domestic S corporation and a domestic C corp. When income is allocated to domestic persons, generally no withholding taxes apply because they're not foreign persons or foreign corporations. The non-U.S. owner here, so Emma, again, doesn't have to obtain an ITIN or file a 1040-NR because all the taxes are being paid at the C Corp level, and any dividend taxes are withheld at source, and they're reported on the 1042s, okay? Now, what are some of the cons here? Well, we've now got 3 entities, right? So more entities require additional money, additional costs, more filings, and sometimes companies want to remain a bit more lean structurally because they don't want all this additional admin. And that's fair, right? I mean, sometimes adding all these companies, it just creates a mess and it's harder to kind of manage, and you have more annual costs to maintain the structure. The other con, again, the dividend withholding taxes is still an issue, right? So Emma is basically paying 21% on her allocation of the profits from the business, right? That's at her C Corp level, and then to the extent that she takes dividend distributions, she's got a 30% withholding tax. The other con here, the estate tax issue still remains for Emma. She is a direct holder of U.S. corporate stock. That's a U.S. situs asset. If she were to pass away, that would be included in her taxable estate. All right, so now let's go on to the last one here. Now, we've added even more entities. Okay, so how does this one change? The left-hand side stays the same, right? We've got our LLC partnership funneled down to Frank, his S corporation, and then Frank owns 100% of that S corp. The right-hand side, Emma, largely the same, except we've added one more additional entity. We've added a British Virgin Islands, so a BVI corporation. So now, instead of Emma owning the Delaware corporation stock directly, she owns 100% of a BVI entity, and that BVI entity in turn owns 100% of her Delaware corporation. So the filings remain the same, right? So this entity is filing a 1065. We got an 1120S over here for Frank's S Corp. Frank's still doing his 1040. He's got pass-through income the whole way, right? On Emma's side, she's got her income flowing down to a Delaware C Corp, files an 1120, pays the 21% corporate tax, and then to the extent they want to distribute any profits, they can. They can distribute dividends, but now dividends are not being paid directly to Emma. They're going to her intermediary BVI Corp. So any dividends going down to the BVI entity is a foreign corporation, so the U.S. FDAP withholding rules still apply. So she's looking at a 30% withholding tax on anything that gets pushed down from the Delaware corporation into the BVI entity, okay? So what are the pros and cons of this structure now? Well, they're largely the same as the last one, right? So everything is basically the same except for the U.S. estate tax issue. So this is where it changes. The U.S. estate tax for non-U.S. persons applies to U.S. situs assets held within their name personally. So the workaround here is to never have a non-U.S. person hold anything in their name personally that's in the U.S. You use a foreign offshore blocker corporation. So this entity is referred to as a foreign blocker. Now, if Emma were to pass away, her estate would not include any U.S. situs assets because she doesn't own this stock directly. The foreign corporation owns it. And the foreign corporation has indefinite existence, unless otherwise stated in the charter. So basically what happens is Emma might have some estate or death or transfer tax issues in her home country, but from a U.S. perspective, no issues here, right? So this BVI entity serves as a buffer, a blocker to protect Emma from those U.S. estate tax problems. So if we look at that's the plus side, right? So we've eliminated the U.S. estate tax exposure, but what's a con here with using a foreign corporate blocker as an intermediary? And so the big one is the foreign corporate blocker is going to be subject to those U.S. dividend taxes, 30%, but depending on where you set up the entity, you might lose treaty benefits. So this example for Sebastian here is a good way to illustrate the point. So Sebastian is a French tax resident and citizen. If Sebastian were to hold a direct interest in that Delaware C Corp, he might qualify for benefits under the U.S.-French treaty, right? And under that treaty, the withholding tax rate on dividends going from a U.S. C Corp to a French citizen resident is going to be 15% and not 30%. However, if Sebastian wants to avoid that estate tax issue and uses a BVI company as that intermediary, like we see similar in this structure here, he's going to lose the U.S.-French tax treaty benefits unless he can argue that that BVI holding company is a French resident, right? And so instead of getting the preferential 15% rate, it reverts back to the 30%. So with the estate tax planning, a lot of what you're giving up is you're paying more money year to year on dividend income, but you're saving yourself a fortune on the potential U.S. estate tax issue, right? So that's what you have to ask yourself is, do I want to pay all these taxes, on my death to the U.S. because I have all this estate tax exposure? Or do I want to use a foreign intermediary blocker entity to avoid that estate tax, but it might mean that I have to pay higher withholding taxes on dividends, rents, royalties, other types of U.S. source FDAP income that might be getting paid into my foreign corporation. Okay, so that covers all that's the last slide, slide 11, that covers all the structure options here. Generally speaking, this is the structure that I try to recommend that my clients go with. It's a lot of entities, so obviously the admin is more, there's more filings, but overall, generally is beneficial to both the U.S. and the non-U.S. persons. It protects the U.S. persons, it protects their pass-through tax treatment, does what we can to limit their self-employment tax exposure, and then on the non-resident side, what we're going after is trying to limit the amount of tax filings the individual has to do. Remember, if Emma uses these intermediary entities, she doesn't need an ITIN, she doesn't have to file a 1040-NR. By using the foreign blocker corporation, she shields herself, her estate from U.S. estate tax exposure, right? Any taxes on income are just paid at this entity level, keeps it kind of clean. Now you can get creative with Emma can draw salaries out of these companies, right? That's a good way to get deductions at the entity level. And then she doesn't have any to pay any U.S. Income tax on her wages. That's fine. But from an overall structural perspective, this generally helps minimize the overall tax footprint on a year-to-year basis. And then in the unfortunate circumstances or event where Emma would pass away, and we need to be cognizant of the U.S. estate tax implications that would impact her. Okay. All right, so that covers it. I know that was quite a lengthy video. but I hope it was helpful. If you have any questions, please feel free to leave me a comment below. I try to answer as many of those as I can. And I look forward to seeing you again on the next video. Thanks so much. Take care.